All right, welcome everyone to today's webinar. It is Thursday, October 15th, so hopefully if you got an extension on your taxes, you got that in today, because that would have been the time to do it.
That's right.
So yeah, for those of you that forgot, well, you can still file, of course. But yeah, we're excited to be here. Thanks, Kevin, for joining us. We appreciate that. I know for those of you that are on the West Coast, it's 7 o'clock there on the East Coast. We got a great webinar prepared for you today. We're going to keep it light and fun. We have some good data and things that we're going to share for things to look forward to for the remaining quarter and into next year. We have a couple of announcements that we're excited to make. We will do some Q&A at the end, so we'll hold that. Just go ahead and there is a little chat there that you'll see that says Q&A. So just go ahead and type your questions in there, and that's what we'll get to at the end, and we'll do a rapid fire round of some Q&A. So we'll do that. So Ben has a couple of announcements to do and go over for what's upcoming, and then we'll kick things off and bring Kevin on.
Yeah, so first of all, for everybody that's here that was at our last event in September, thank you so much for attending that. Hope you got a lot out of it. And that was one of the big reasons why we actually wanted to do this, because of the feedback that we got, and it's going to go deeper in our levels with Kevin and what he's going to be talking about tonight. But thank you again for supporting us. We greatly appreciate that. Share more about Noteworthy. This is a business that is a really small circle. And, Aaron and I really have this vision of bringing note investing to, a bigger audience. And that's why we're going to continue to do these things and events. And even if we have to get creative in the way that we do them because of COVID and everything else. But here we are in the fourth quarter of the year, which has been the craziest year I can ever remember in my entire life. And it's not even over yet. So, but what we're going to talk about tonight and, Kevin's going to share with you are just some things that you can get yourself prepared for, his vision for the industry and all that good stuff. But if you want to learn more and keep up with us, check out our podcast, the Noteworthy USA podcast, which you can find on iTunes and Spotify and Stitcher and whatever other podcast apps there are. And then also, if you haven't already, subscribe to the newsletter. I mean, we're really proud of it. We've worked really hard on it. Kevin's a contributor as well. We put it out every single month. There's great articles from industry experts. So if you're like a complete newbie and you're just like, hey, I don't want to ask stupid questions or what you perceive to be stupid questions, which I don't think there is such a thing, but you can learn a lot just by reading the content that comes out in the newsletter. And, it's something that, again, we're really proud of it. We work hard on it and we're going to continue to do that. So it's usually runs anywhere from, 12 to 18, 20 pages a month. So, and we've got some great contributors. There's assets in there that you can buy, tools that can help you in the trade, so we're going to, and recommended reading and listening and all sorts of good stuff. So be sure to check that out. For the podcast, again, iTunes or Spotify. And for the newsletter, you can go to notetools.com/newsletter. And that's all I have to say about that.
So a couple shout outs. So thanks, Ann, for being on. Bob, Kathleen, I see you. Greg, Lincoln, Robert, Roger, Rosanna, Stuart, Stu. I always love giving public praise and recognition for those going on. It's what grown men cry for and babies die for, is public praise and recognition. So thanks for being on. Really appreciate it. So two other things. December 3rd, we're going to be doing a full day workshop intensive with Kevin. He's going to peel back the curtains, for his what he's doing in his investment business and his group. And then Ben and I are going to do a presentation on what we're doing in our investment business, specifically what tools and resources we use, how we manage our staff. We're going to share that. And then we have a guest speaker that'll come on and talk about some private capital raising efforts and things they're doing. So try to break it up a little bit, but it'll go all day from 10 a.m. to 5 p.m. Eastern Standard Time. We will record it. Recordings will be available. It's super cheap to go to. It's like $39, I think, is all we have it. But it's like just jam packed of content. It's just the three of us, doing a full day together. And then you go to NoteWorthyWorkshop.com for that. And then end of March, we're just finalizing the dates and the venues. It's been a little difficult still with COVID and everything to get, a decent venue and good enough capacity, for social distancing and stuff. But we're going to do it in Orlando, and it's going to be end of March. And we will have a live stream virtual option for that as well. So we're excited for that. Those are some of the things that we have upcoming. Let's go ahead and bring Kevin on. You can unmute yourself. Welcome, Mr. Kevin Shortle. How are you doing, bud?
I'm doing great. How are you? And hello, everybody out there in virtual world.
Yeah, it's awesome. I mean, this is definitely the new norm, and it's pretty. I think it's cool, man. Like
I've been doing a lot of them, and I'll tell you, I think it was something new for everybody, but it didn't take long to get used to it. I do rather enjoy it.
I know.
Does anybody else think that Zoom planted the COVID virus?
I know. for those of you conspiracy theorists out there, I see a lot of you too. Y'all might have saw me. I attended the IMN virtual event the past couple of days, and that was pretty cool how they did the format. It was a little confusing, I thought, on some of it, but the content, the panelists, the speakers, that was cool. You can actually, I think, get a comp ticket if you know some of the vendors. Just an FYI, they're a big event production company. I mean, that's what they do. They don't like specialize in anything other than hosting events, but they got a lot of cool industry stuff. And so we're excited, Kevin, to have you on and go through kind of what you're seeing that's been taking place. We wanted Kevin to kind of give an overview of, what he's seeing, some of the research he's seeing, some of the stuff he's been working on with some of his coaching students and how he's been able to help them take action. And then we'll do some Q&A at the end. And then, we hope to see you in December and March. That's really all we got planned until then. And we're just going to take some time off for the holidays with our families. So Kevin, I know you're going to fire up a little slideshow and grace us with your, I don't think anybody articulates our space better than you do. You got a good radio voice.
Well, I appreciate that. Let me switch displays here for us. Great. You guys can see my screen?
Oh, yeah.
Okay, fantastic. Perfect. All right. Thank you for that. And as you guys know, and hopefully most everybody on the Zoom tonight knows, for years, I've been studying the marketplace. I keep up with it on a very, very regular basis, and I'm fortunate to do all the state of the industry addresses at the NoteWorthy conventions, which I did one a couple months ago, but things are always a little bit in flux, and I do keep up with that. So I did want to share with you some new things since that event and where we're heading, because before that event, we really didn't have numbers about all of the forbearances and what may happen with that, and that's starting to come out now. So it's starting to shape a little bit of what's likely to come in the future. So I put together some of that for you, and we'll start right there. So this is from a company, by the way, and I source everything that I do here. This company called Black Knight Financial Services, and they specialize in this sort of data, and they track it nationwide, and they put together some nice reports. And this was a really good summary I thought that we could start with here, because this has changed a little bit from when I did my last State of the Industry address here. So starting on the far left, you can see the change in delinquency rate. Now, delinquency is the mortgage is late, and up to 60 days, they just consider that delinquent. It moves into serious delinquency after 90 days, and that's more or less an industry standard there. So on the left, they're talking about a change in delinquency rate on the 30 to 60 day payment period there. And you can see that has dropped down, 0.5% here, but it dropped down in August. As you can see, in August, the sum of all early stage delinquencies fell 9%. So we're starting to see that the people who are coming back and making payments after forbearance are starting to make those payments again. We're not seeing people with new loans getting into trouble in the early stages. We did see that several months ago, and that's why the serious delinquency rate in the middle of your screen there has gone up by 5%. In fact, it has gone up every every month for the last 5 or 6 months, I think it might be, and 5 months. And this is the smallest increase, though. So for the last 5 months, the serious delinquent rate has been going up, but now it only went up 5%, and that's the smallest in that series. And that, for most experts, is starting to indicate that we've hit the peak here at serious delinquencies, or at least we're tapping out. So things are starting to settle just again. And it doesn't look like, at least with the number on your left, that we're going to see another little wave of those. It could happen, okay, which I'll get to in just a minute. But for right now, that's what it's looking like for serious delinquencies. Now, the serious delinquent number is an important one because statistically, once a borrower gets 90 days behind, it's very difficult for them to come back and get current again, coming up with 3 months worth of payments and structuring it. So that's why 90 days is such an early indicator of what's likely to happen. So there's only a small percentage of people after 90 days that are able to make up those payments and get caught up again. The rest slide down that slippery slope of either loan modification, forbearance, or, as you can see on the right-hand side of your screen, foreclosures. Foreclosure starts is a very interesting number. In August, which is the latest data, by the way, the report just came out this month, just so you know. The report just came out, in fact, last week, but they report back. They're always looking in the rearview mirror, right? What happened? So this is what August stats reported as of October. The foreclosure rate in August went down 40%. 40% foreclosure, which is an indicator that if we have serious delinquencies happening, which puts people in jeopardy of foreclosure, but we see the foreclosure rate going down, it means either that banks are under a rule, which some are still right now, that they can't foreclose because judges are not hearing those cases in judicial states, et cetera, or there's a moratorium on enforcing those, or the lenders or the lenders are working with borrowers to modify those loans and therefore not have to go down the foreclosure rate. And the third thing really would be that instead of foreclosing, they're taking those notes that are in delinquency and selling those. And that's really the three main components that would make up that statistic. So when you see a drop like that of 40%, that is significant for us in the note business as well as the real estate business. So despite the vast numbers of serious delinquent loans, as I just said, foreclosure rates continue to drop due to forbearance plans and moratoriums, as I indicated. Nearly 2.4 million properties are 90 days past due, but there was only, get this, 6,000 foreclosures in August. 6,000 foreclosure starts in August.
6,000.
What's that?
6,000.
6,000 nationwide. I mean, that's in this country, that's absolutely really nothing. So again, these moratoriums have stopped that, the forbearance plans, and also, again, some banks don't want to deal with foreclosures anymore, and they simply take those loans and they auction them off. In fact, if you still look at Fannie Mae sales and Freddie Mac sales, which I do, they're still having billion-dollar sales of non-performing loans. In fact, Freddie Mac had one last month. Right? So they're still out there, and a lot of that inventory comes down a different path, if you will. And it's still for the same reason, by the way, which is Dodd-Frank. The Dodd-Frank Act put a heavy penalty on lending institutions, FDIC insured, et cetera, institutions, the ones who work with Fannie and Freddie and Ginnie Mae. They put bigger penalties upon them for having non-performing assets on their books. And when they get into the penalty zone, the banks get motivated to get rid of them. The penalty is 10%, right? So if a bank has $1 million, it's 10 times. My apologies. If a bank has if a bank has $1 million worth of non-performing assets on their books and they're under penalty, they would have to have 10 times that, or 10 million in cash reserves that they can't lend, that they can't do anything with, which is crazy. So the purpose behind it is to motivate those banks to work with the people or get them off the books through foreclosure. Well, foreclosure can take a long time, especially when there's moratoriums, right? So what a lot of them do instead is say, well, get that $1 million off my book, just sell it in an auction and sell the paper. So that's another reason that you're seeing these numbers. And that's significant because if you're a real estate investor, you have to be sensitive to that. If you're looking for distressed properties in foreclosures, you can see it's going to be very challenging. Right? And that's going to cause competition. You're going to be overpaying for assets. Assets are going to go quicker because there's fewer of those distressed on the real property side. And that moves the market over a little bit to the paper side of the business. Okay. So by the way, overall, according to Adam Financial, so different data source, but same type of company, foreclosures are down 81% from a year ago. That's significant, folks. So those properties, by the way, check this out too, also from Adam Data Financial, those properties foreclosed on in quarter 3 of this year spent an average of 830 days in the process. That's up from 685 days in quarter 2 and down a bit from 841 this time last year. It can be a lengthy process. Imagine if you're a bank and you have hundreds of millions of dollars on your balance sheets that are non-performing, and you're facing putting 10 times that in cash reserve for 830 days. Or do what? Sell the paper. You might keep a small amount of certain foreclosed properties. There'll always be a certain amount of foreclosed properties, but that's an interesting thing to take a look at. As far as the forbearances and how they have worked out, rather interesting data has now come out. Black Knight Financial Services through their McDash Flash platform here. So this is the pie chart of all the 6 million people, 6.1 million people that were granted forbearances. And since that has occurred, you can see that 46% of them, 2.8 million, have got an extension on that. Now, these extensions occur every 3 months. They can occur. You have to petition for that. They could go up to 12 months. So that's still going to play along. But that's not even half, right? I mean, that's under half of the people asked for that extension. You had another 41% here. If you look at the removed, expired, delinquent, and paid off, that's 41% of all the people who are in forbearance. Removed and expired that are now performing, 1.8 people who were under forbearance agreements, 30% of all the people are off forbearance and they're making their payments. And we see that they're making them on time if you compare that to the other statistic there. The ones that have been removed and they're delinquent, but they're in active loss mitigation, which is 4% there, 267,000 people, that means that the banks are working with them. I expect that number to grow as more people come out of extensions, by the way, because of the amount of equity in people's properties today. It's in lenders' best interest when there's equity to work with delinquent borrowers if they show the ability to start repaying. It makes sense for them to do that. And it's good for the overall economy. It's good for the borrowers. We didn't have that back in 2008, 9, 10. Back in 2008, 9, 10, a lot of people owed twice what their house was now worth. There's no incentive in there for a lender to work with those folks. Here there is, and that's also going to be a significant number. Expect that one to grow. The ones who have removed from the forbearance program and there are now delinquent is only 1%, 54,000 people. You can see out of that 41%, 363, kind of a shocking number, 6% paid off their loans. Okay, and then you have the remaining 13% that are still under the original term of their forbearance. So this could indicate overall a softer landing or a landing that crescendos in inventory rather than a slam dunk of now we have 4 million people in non-performing that are facing foreclosure like we had in the last crash. It seems to indicate that some percentage, a high percentage, let's say a third, are going to be able to start reperforming, and the banks are going to start to work with more and more people after they come off these extensions. But again, no crystal ball here because, again, there's so many things politically, job-wise, COVID-wise, I mean, everything else that we're looking at here. But just to show you how different this is as far as equity goes, this is a chart that shows equity. It goes back to 2004, and you can see in 2010 how nationwide equity in properties just took a big dive, and it's been climbing ever since. Now, right now, it's at 6.6 trillion. So this is nationwide tappable equity, meaning equity that people could borrow against. They could do cash out refis. Of course, refinancing has been popular as equity has grown. It has leveled off, right? So you can see the leveling off up here of that equity, but still, this is a massive amount of equity that we have, which was even better than 2005. So we're way up here, and that's going to incentivize lenders to work. So the people who are trying to time the market and say, well, I'm going to keep, money aside and wait for this big crash, wait for this big event, you might be surprised that it doesn't happen. Okay. When I did my state of the industry, I told everybody this is a market that you can't really make predictions in because there's too many things that we're dealing with. And at that event, I talked about here's what we do know, and let's focus on that in our preparation. And my clients have been going right through this because this has also created other opportunities. Some people who own notes are starting to get concerned. They're starting to sell inventory. You have other people that are shifting inventory. And I think if you are going to really build this as an investment, you keep playing in the game. You just have to know what's going on where you are and where to focus your effort. You don't try to time the marketplace. It's like trying to time the stock market. And from what I understand, that doesn't usually work out too well, right? It's the ones who are steady, the ones that are consistent, the ones that understand, well, maybe now I have to shift here. I'll shift back here when things are ready. So let me give you an example of that. I had, I was going to put together like 13 different things, and we're going to cut it down for you here. But I'm working right now with a lot of new people to the note industry in my consulting business. And they heard about notes. They're interested in notes. Some of them from the NoteWorthy events and from the magazine and the podcast and my podcast and everything else. They're interested, but they weren't quite ready to get going. And I guide them through the process of purchasing these assets. And I've had 13 new clients, of which about 90% of them are brand new to the note business. The other 10% were more experienced, but they hadn't really done that much in the business, again, because of just wondering where we are in the market, what to look for. So just in the last 2 months, I wanted to compile some data so you all listening to this Zoom can understand what they're doing. So all these deals I'm going to show you happen within the last 45 days or so, maybe 60 days on one of them. So here we go. I think you'll find this interesting. Go ahead. Sorry.
Let me inject something real quick, if I may. So I'm trying to kind of piece some stuff together. A good friend of mine, we were talking a few weeks ago, and he told me Wells Fargo. So he's employed, never been late, never missed a payment on a fixed 30-year with Wells. Okay, and Wells kept it and is servicing it. They contacted him and offered to put him on a forbearance if he wanted to. Like, they just offered it to him. And so, for my understanding, though, and they did it. They offered it to him for like 6 months. I was like, what? I'm trying to like wrap my head around why they would do that. But anyway, so my understanding though is if he takes them up on that loan then becomes a non-conforming type loan because of it going into him electing it to go into forbearance, and he doesn't have to catch up. They're just going to tack it on the back end. Okay, was the offer they made, and it's like, yeah, you essentially don't have payments for 6 months. Save your money. We're just going to throw it in on the back end, extend out your loan term.
Right.
I'm trying to do you have some like color commentary that you can? Have you heard of this happening? I was just like, really? I was like, I didn't understand. I was trying to put it together.
Yeah, I didn't know that there was an outreach to people to do that. I thought it worked the other way. Strategically, why would Wells do that? My guess would be that they were encouraged or perhaps pushed that way, because the reality is Wells Fargo, as most banks, which is one of the bigger lenders in the United States, Wells Fargo really is a servicing company.
Yep.
That's what they are. They don't hold much in their own portfolio. In other words, they originate loans, they turn around and sell those loans to Fannie Mae, Freddie Mac, and Ginnie Mae. And then they service those loans by collecting the principal, interest, taxes, and insurance, much like you who own notes and you use FCI or Allied to service your notes. Banks end up in that role and retain the servicing rights. So they hold the escrow and make money on the prepaid insurance and taxes and such. So my guess would be, and it is a guess, just an educated guess, Aaron, that the federal government pushed Wells Fargo to do that. That's the only reason I could think of why they would do that.
So does that affect, though, the status of, what their loan becomes? Does it move it into like a type of non-conforming by them?
No, and I was going to come back on that term and ask you if you meant to say that it doesn't become a non-conforming loan because they've conformed to the guidelines of that. So no, it's still a conforming loan. It just has gone through a forbearance, and it won't. People won't get penalized for being under a forbearance. That was part of the mandate and part of the option that they had. And quite frankly, even people who were working, why not, right? Even if you're working, why not? If you're not going to get penalized and you can move those payments to the back end, because what I heard also on the other side of this was Bank of America was telling people about forbearance, I thought being called about it, and they were making a plan where we'll give you forbearance, but in the fourth month you have to catch up on the third. And you had a request to have it put on the back end, because there were three options. Essentially, missed 3 payments will allow you to do that, but you got to make them up in the fourth, which is crazy. Yeah, right. If you're not working, how are you going to do that? Or they could just add it into your monthly payment and re-amortize the loan, or put it at the back end. You could get either one. You just had to instruct Bank of America to the back end. But how many people know that? That's not right by them. But so that would be my guess on that situation.
Well, I just wanted to add a little commentary. Somebody just chatted in too that their lender did the exact same thing. Just reached out to them, said, "Hey, you want to forbear?"
It must have been part of a mandate then. Yeah, it must have been part of the mandate.
Cool.
Yeah, and they didn't, I don't know, your loan must be categorized in something, because they didn't reach out to everybody if there was only 6.1 million people in total. So, their loans must have fit in certain categories or ratios, and they said, you need to reach out to these folks.
Sure.
Yeah. Awesome. Okay, so getting back to this, so deals just that any one of you listening could have purchased yourself. Nice looking house here in Cleveland, Ohio. The BPO in this, believe it or not, $34,500. And I know we've got people from all over the country here. And I know sometimes when you show these houses in mid-America, people go like, what? This would be hundreds of thousands of dollars where I live. I get it. And that's why in this business, part of this is the understanding of you go to where the deals are, you go to where the opportunities are. If you want to deal in higher end notes, you can absolutely do that. You're just competing with bigger investors. So a lot of people diversify through other areas. So I purposely listed where these properties are located. $34,500 BPO on this property. And this was two gentlemen new to the business, not new to real estate though. These guys were real estate investors, fix and flippers that just are looking around. They happen to live here in Central Florida, and they're going, where's the inventory? And any inventory we find is so overpriced where our margins are razor thin. When you got razor thin margins on a rehab and you make one mistake, you didn't recognize, when they open up a wall, all of a sudden they figure out, oh my gosh, termites said, well, whatever. Your margin can be completely gone. And now you got to switch to some long-term strategy here. So they just were smart real estate investors who ran out of inventory, heard about notes, and they bought this one within 30 days of working with me. Okay, paid under 20 grand, right around 19. I was trying to find the exact number for you. It's right around 19. So I just put under $20,000. Folks, that's a 15.23% yield annually. And you're not a landlord. You're not getting the phone calls, any of that sort of stuff. You're not renting and then paying out all the expenses and left with this amount of money. This is money coming in every single month like a bank. And this was a very well-seasoned note. The payment history was solid solid for the last year. They haven't missed a payment. Less than 30 days of being in business. It can happen this quick, understanding the due diligence. So part of what I'm going to do in this one-day event we're having is show you how I do due diligence. That's what's getting these results. I have a pattern. I look at deals every single day. That is what I do. And I have devised a way to go through this on a systematic approach that gets you to understand, is this good or is this a bad deal, in two different occasions. And it's a system of checks and balances, and it'll change how you look at this business for sure. This was another one. Michelle is a busy executive and a full-time, not a full-time mom, executive and a mom. She's been in the note business, but not really doing anything, because sometimes you get to the point you're going, I don't know. You know, it's great to learn about the thing, but when you're writing a check to buy something, it really becomes real at the time. And you start to get those thoughts of self-doubt and can I do this and that sort of thing. So this one, $94,600 BPO in Birmingham, nice area. There's a lake behind there, nice looking property, well-maintained property, as you can see there. $25,000 for the note. 25 grand for the note. Now, again, 11.79% yield, but also think of the risk involved here. What if things go wrong? What if they don't pay? Is your investment okay? Right? Your ITV on a performing note, being, I didn't do the math on this, but you can kind of ballpark it and say you're in it for what, 28% or something, right? If it's a $100,000 home, you're in it for 25 grand, you're in it for 25% investment to value ratio. Aaron, you remember the days when a non-performing note, you could get that. You couldn't get a performing note anywhere close to that. And a lot of these performing notes are well seasoned now because they were a result of a non-performing note back in 2009, 10, 11 that's been performing here again. So she doesn't have the ability to do this full time. She'll look again once a week. And once she got the confidence of going through this process that I have of checks and balances, she said, I have to do it. And it's turned out great. She can't wait to get her next one under her belt. This one is Sarah. Sarah's brand new to the note business. She's a really energetic lady. She's from Africa, and she just is totally in love with this business now. She just did, this was her first deal that she just did, closed on a couple of weeks ago, Springfield, Illinois. She doesn't live there. Again, we go to where the deals are. $38,500 on the BPO. She got it for $22,500 with 163 payments remaining. So for $22,000 that she's investing, she's getting in return 163 payments of $344 per month. That is a 16% annualized return. Now, what she's probably going to do is sell a part of this note to another investor at a 9% yield, at an 8% yield, and get most of her investment money back so she can do what? Reinvest. So there are still deals out there that you can do this. Again, this is all right now. This is not years ago you could do this. This is in the last, for this one, the last 3 weeks for sure. This one, Leandro, came to the United States 2 years ago from South America, anxious to get started, heard my podcast actually, and got in touch with me and started working together. And he was anxious to get going, went through everything, very disciplined. Once I showed him the system, he just implemented everything that I did. He utilized the same spreadsheets and such that I did. He actually made some improvements on on mine and made some additions on there. So sharp guy. But again, this was a new set of skills for him. So the first one he bought's on your left there in Gadsden, Alabama. That was within 30 days, again, of working with me. He bought the other one in San Antonio about 2 weeks later. And he lives here in Florida. So again, we go to where the opportunities are within this. If the numbers make sense, and what you'll learn when we talk, when we're going over this in detail at the one day, it's also the story behind it. Because the story and the numbers is really the combination to truly master this. A lot of people just look at the numbers. That's a mistake. A lot of people just understand a story, perhaps not so many people, but that's a mistake too, because the numbers have to make sense. You have to have a combination if you're truly going to master this, because that's what enables you to think in terms of what are my outs. You've got to go into these deals with 3 outs as a minimum, and we'll talk about exit strategies and everything else coming up as well. 38.8 on the BPO on Gadsden, 120. So again, there's ranges all over the place. The $120,000 property, the note on that he bought for $57,000. That's a 13% yield, if you will. The other one, got a little typo there, 118 payments of $386.90 per month, making it a 15.9% yield on those assets, and they're performing. They're all receiving payments on these notes. So it really is the approach that you take, the due diligence that you take to have the confidence and the ability to say, this is a good one. Here's why I'm going to do it. And here's the most likely outcome. Here's the second most likely, the third. And you have multiple exit strategies where if something goes wrong, if something doesn't happen, you're still going to make money. If you're investing in these notes this way, the way I teach you, that's going to be a game changer for you, because I am known in the industry as, first of all, the trainer's trainer. I've taught a lot of people who are now actually training doing some trainings themselves and such. And I think it really becomes, I study education as well. And I understand, how do people process information? How do they need to hear it? How many times do they need to hear it? What are some memorization techniques that they can utilize? And I can break down complex things into simplicity. It's just something that I have within me. And I thought I would share with you all just this. You can see it just got to me last night at 10:40 p.m. And the main focus on this one, I circled there for you. I tell you, Kevin, I really mean it. The way you break things down really helps me exponentially. And that's what I want to bring to you all at the one-day event, and just going through this. In fact, what I plan on doing at that one day, which I think you guys would really like, is take some of the deals that you just saw and let's go dive into them and see what they saw, see why they purchased that particular deal. Because sometimes you can reverse engineer that and go, well, of course I would have bought that. I want you to have that ability, and then we'll apply that same thing and say, let's start from the scratch with a brand new one. Let's drill down on this one. And I'm going to take deals that I haven't even pre-rehearsed, by the way, folks, because that's the real world. We might go through class and look at one and I go, nope, we're done with this one. This one doesn't make sense. Here's why. Don't waste your time. Move it on. And we'll go to the next one. And the next one we might be like, well, somebody better buy this right now before Aaron or Ben jumps on it, right?
Let me point something out that I want to address that I think is on a lot of people's minds because of, the moratoriums on evictions.
Yeah.
Okay. And foreclosures. So, I think, Ben, you did a recent analysis on the portfolio, across the portfolio. Do you have that memorized, like what your percentage of breakdown on the portfolio is that's still performing, or 30-60 late?
Yeah, it was, that particular portfolio, it was still good. I think it was probably somewhere around 80% were still performing.
So
if I could interject there, Aaron, too, I haven't heard from a single investor where they're going like, oh my God, nobody's paying. I've heard that from some people collecting rent, but I really haven't heard that from any investors in the note industry.
Well, here, the reason I bring that up is because, it's hard for us as we're keeping up with current events. And this is why we do, we've been doing more of these educational webinars to, because in mainstream media, we don't get this kind of information. We're like, oh, everybody's portfolios are suffering. It's just like kind of a doom and gloom picture, but it's actually not the picture, especially in our industry. Like, at 80% plus, for the portfolio to be performing is amazing, especially right now. So I think, part of it is the information that's being fed to us out there. And the other part of it is like, it's important for us to stay in the loop, network, and have this community to talk about those of us that have portfolios, that are a little bit more seasoned and established, and those that are just starting out too, like you need to hear this information so you can get going and feel comfortable and not necessarily feel like you got to sit in cash, or wait till like post-election or into next year. You can get off the sidelines and get in and feel confident. Like that's one of the big things that I want to communicate to everybody listening. And there's out there is like, get in and start taking the action and doing it. That is the key to learning. Even if you make the mistakes, it's okay. That's how I started, back in 2011, 2012, I just got in, I was sitting in cash too long, started getting in and just working out the kinks and having a good community, keeping us up on current events and really what's going on. We don't have a 20, 30%, performing portfolio with, 70 to 80% non-performing. That's not the case. That's not accurate at all. So anyways, I just wanted to kind of interject that and articulate, like, here's what we're seeing, and it's important. There still is inventory. Is there an abundance of inventory? Well, no, there's not. Is there still deals out there? Yes, there is. In fact, we sent out an email, like a week and a half ago, Ben, and how many people responded back that were like sending us deals for us to review? What is like? How much?
I literally got over 400 emails.
Yeah, so there you go. That was one email. And they're like, hey, we got some capital, bring us some deals, or we can, joint venture, we'll help wholesale them out. Yeah, over 400 emails. So there's deals out there. And these weren't like option contracts or, hey, I'll do an assignment. It's like, no, they're deals ready to go now and be funded. So I think that's important.
Yeah, you mentioned something there, Kevin, that I wanted to unpack a little bit. And that was about that trend of, like riding the wave. Just the sophisticated investors, they keep investing no matter what's happening in the market, right? Like they just never stop. They're just making adjustments. And well, what if you don't have the confidence to do that? I mean, that's really the separator between the investors and the sideliners is the confidence. And confidence only comes from knowledge. So it's because you lack some sort of information that you can't make a decision. That's all it really comes down to. So when we do this deep dive with Kevin, I mean, it's going to be a total evaluation of notes demonstrated to you by an expert. So they say the way to get to Carnegie Hall is practice, 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 right? Well, you're looking at a guy that's put in well over 10,000 hours of practice on this. He's a master of the craft. And if you're going to learn from somebody that's in that, that's the type of person, iron sharpens iron. So if you can get in with somebody in that fashion, it's going to set you up. And Tony Robbins always says, like, the quickest path to success is modeling. This is the kind of person that you want to model. It's why Aaron and I bring him to you, because he's such a great resource of information and how to dissect a deal and what to buy, what not to buy. And just to have access to that for literally $39 that you can unpack his entire brain in a day is like, will probably make you tens of thousands of dollars if you really pay attention. And most importantly, like Aaron said, you take action on it. That's like the key piece. So you can go sit and learn all day, but if you don't have the ability to take action, don't do it. Like, don't even bother signing up. Like, Kevin's not going to waste his time. So, but if you like have the ability to take action on something that you learn, that's what got me involved in Noteworthy. That's what got Aaron involved in Notes. It was just like, okay, I learn and then I do, is the speed of which you can take that action. So
we had a good keynote at our last 2-day event. When did we do that? Did we do that in September? That was last month or August? Was it September?
September.
Or 2-day? September. And a good friend of mine and also Ben's, Mark Evans, had a great keynote where he was going over taking action. And he's been a deal guy, since he was 19. He's in the Columbus, Cleveland, Ohio markets. But anyways, check that out. Go back and review that again if you missed that. That was on the first day that we did that, and we did for about an hour or so. Okay, Kevin, we'll turn it back over to you.
Oh no, I was I'm all set unless there's questions. Oh, Q&A if we have time.
Yeah, we can do some Q&A.
Yep. So, okay, down in the little box there in your screen, you'll see a little message box that says Q&A. So go ahead and just type your questions in there and we'll fire that up. So Kevin, one of the things that the people are asking is, what are you finding? Where are you finding your deals right now? What are some of the sources you're using?
Well, there's public sources like trading platforms, and several of those assets came from there. There's also semi-private inventory. When you're in this business long enough, and especially someone like myself who has trained so many people in this business, I know of private investors who have their own portfolios. And if I'm looking for something, I can reach out to them to see what they might have and be willing to sell out of their portfolio. So some of those deals are a result from that. And then some, there's other techniques that you can utilize to find out who are active investors. And one of those examples that I showed you there, when I was reviewing the note with them, I was really impressed how this person created the note. And I was telling him, I said, this seller knows what they're doing. They know exactly what they're doing. They're borrowing money to buy the property. They're selling the property on terms. They're doing all the proper qualification. They're doing textbook work on making sure it's all in compliance, to make sure that they're getting a proper buyer in place, not just any buyer. And I told him, and I said, this is somebody you need to build a relationship with. So one of the other great sources, and I'll tell you, he's now probably on his fifth deal. One of the guys that I showed you there, and all of them have been with this same guy now. And it's almost like he has built in his own business. This guy's creating stuff, and then he's going to be buying the notes, and now he's going to bring in other investors and do that. So there are companies in the big REO companies and such that you can literally learn enough in the business, network enough. I mean, I don't know how many of those guys were at the last Noteworthy, a virtual event, but we certainly had them in the live Noteworthy event before that. And that's a great place to network and build your own business as well. So there's several different avenues that you take in this, because ultimately you want to see as much inventory as possible. And that's where I might have a little different opinion of how much inventory is out there. We don't need massive amounts of inventory. We need good, steady, quality inventory, and that is out there, knowing the right sources.
I think it's all about where you're at in the business too.
Mm-hmm.
Are you a bulk buyer, or are you like a small mini pool buyer, or a single asset buyer? Those are kind of like the three, right? If you're like in this full business, maybe running a fund, or maybe running, your own, single family office, you're probably buying in bulk. And for those of you that are doing that, you'd be like, oh, maybe, man, it's pretty tough. There's not a whole lot of opportunities for that. But if you're like, man, I can pick up 10, 15, 20 assets, there's a bunch of that. I want to pick up 1, 2, 3 assets, there's a lot of that too. So I think, it's also a mindset thing in how you're doing it. So Mr. Cotter says, when payments in forbearance are postponed to the end of a note, what happens to the interest due during the period of postponement?
Nothing. It's a freeze on the loan. It's just a pure freeze on the loan. Nothing else changes. They just start making their payments in 90 days, unless it's a bank originated loan and they petition for another 90 days. And they could continue to do that for now up to 12 months. So nothing really changes other than that. What the bank does is they move the payment to the back end, right? So it's easy to visualize that way too. You didn't pay this one, I'll just stack it on the back. So they're extending the payout period of their loan by 90 days each time they do that. Now, on a related note, by the way, if you own a private note yourself, you are under absolutely no obligation to do a forbearance.
Yeah.
None. It was only federally backed loans that were mandated, not us. We're not federally backed, so we didn't have to do forbearances. And most of the investors I know did not do that. The ones that were asked to do that, I told them this, which is very important. I said, do not do what the banks are doing, which is just saying no payments for 3, 6, 9 months. That is setting people up, in my opinion, for failure, because they're not going to want to start paying again. They're going to try to do everything they can to not, because people work in patterns and habits and such. I said, if you have to do a forbearance and somebody's payments may be $500 a month, lower it to $250 if you have to, but get them paying every month something put the other on the back end, but keep them in the habit of paying on time. Don't do just a zero payment. And the ones who heeded my advice are thankful for that. The loan's not interest free, if you will. It's just there's no payment. So it's essentially, you could think of it as just as a pause, and I'll see you in 3 months and we'll start over again. It's really all it is.
Hey, Kevin, I said at the beginning here that, Aaron and I wanted to bring note investing to a larger crowd.
Yeah.
And, a lot of people think of notes like, all right, I have to have this tremendous amount of capital to be able to do it, and that's why I think wholesaling for a lot of people is so appealing, is because they don't really need any capital to do it, so.
Or brokering or note brokering.
Right. Then that's what I was going to get at. So like, if you look at the wholesaling industry, it's big. Like there's a lot of competition in terms of note brokering. Do you feel like there's a lot of competition in that space?
No. So when he said wholesaling, everybody, he meant wholesaling real estate. We sometimes say wholesaling a note, but yeah, it's the same thing as brokering a note. The issue with note brokering right now is notes became so easy to buy through, again, REO bulk sales, through the bank sales, through the trading platforms, that's what everybody did. Well, that stuff wasn't around pre-2008. Pre-2008, you had to market people that owned individual notes, and we call those the mom and pop notes, people who sold a house and created a note, and that's the only other note that they'll ever do in their lifetime. And those people got ignored during this big buildup. Why? Because you could go online and research and buy notes. Why not? People are going to do the easiest thing. So the inventory of those types of notes have stacked up. On top of that, there's companies like yours, Ben, that buy bulk REO and sell them with seller financing. And you have built up that inventory. So those type of notes, I think the best ones for brokering are going to be to find the individual notes and then market those folks to see if they're interested in selling. You wrap up that deal through a contract where you have an escape. You don't have to close on it, but you got it locked up for 30 days and put a buyer into that note. Those are the best way to do it. That's where you maximize your return. And the good news is you can actually buy the name and address and phone number of as many of those people as you want to.
There are billions of dollars worth of owner financing notes out there. Like, I'm sure Kevin probably has a statistic somewhere. I mean,
you know what we're doing in our own business, which is brand new as far as the note business is concerned. We have a lead list now that we are texting people who own individual notes. We're getting a 20% response rate.
That's huge.
It's just it's mind blowing to me. I mean, you send out a text, and 20 minutes later, it's like bing, 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 and it's like wow. And all these people indicate that they're interested in getting a purchase offer, and that's another reason that I mentioned that particular inventory, because that is a source of capital that a lot of individual note owners probably need. If they're not working, or if they're unemployed, or they're on lower hours, but they own this note coming in. Hey, instead of getting $400 a month, would you rather have 30 grand? So they're a lot more motivated sellers than sometimes the bigger companies, and that's a good place to look as well.
So we're nearing the top of the hour. Any last minute questions before we wrap things up? You just type them there in the Q&A box. Everybody's muted, which is to eliminate any feedback, of course. So you just have to keep it there in the Q&A.
By the way, that's the website link is not on the graphic there, but you can see it up there. It's just NoteWorthyWorkshop.com. NoteWorthyWorkshop.com. If you want to come check us out in December.
You think we were a bunch of professionals or something?
You could probably type that in as a question so everybody could see it, I suppose.
It's all good. All good. Yeah, we love doing this. It keeps us busy, both doing the business, working with others. I've been doing it for a number of years prior, just with, various small businesses and stuff. I do a lot in the self-directed IRA space, as most of you know now. as well. And so, we're seeing a lot of activity, a lot of people moving their old employer plans over to us to self-direct. And, I see a lot of people investing in private companies right now as well, which is interesting, so coming out of stocks, and a lot of people investing in real estate. I mean, those are the two big ones: investing in real estate, investing in promissory notes, both secured and unsecured, doing some lending out of their IRAs. And that's a great way to raise money and work with others as well. There's a lot of people that will continue to move out of the markets, out of stocks, bonds, mutual funds, and self-direct. And that was a huge success that I had in, a previous investment company, a little boutique investment firm we had. And, Ben and I have been raising more money again with these self-directed IRA investors. So it works out real great. So don't forget about that, as you always want to be capitalizing, right? The ABCs of always be capitalizing and getting ready, because we're going to see an influx of inventory. Who knows really when it's going to come? So if you're want to get into the game and start doing bulk purchases, probably end of next year, early 2022, we probably have a ways before it really trickles down, but get ready. It'll come again. It's just a cycle like anything else that we always go through. So
spend these next, 365 days, 450 days, whatever it is, really tuning yourself up, like just getting prepared, maxing out your knowledge, learning these things, spending time educating yourself is the best thing you could do. So I think we should wrap it up, guys. So
any parting words of wisdom, Mr. Shortle?
No, I hope everybody gets on there, and I'm going to give you a lot of value that you'll see. And look, we have so much room in the business, so much inventory. We want people to get actively involved. We're active traders as well, so it makes sense for us to do these things at such a really ridiculously low price for to value ratio here. So glad to do it, and looking forward to putting on the presentations.
We'll be happy to have you on. And I will say, I'll leave it with this. Whether you're a beginner or seasoned note pro, or maybe just somewhere in the middle, this has a little bit of flavor for everybody. Because I'll say this: I used to go to a bunch of Kevin's workshops early on, and I only need one or two nuggets, one or two aha moments or things that I'm going to go implement. Sure, you'll take 10 pages of notes, but you're not going to get to all 10 pages in the next 90 days. So you just need a couple things to get locked and loaded and focus on. That's why I like Gary Keller's book, The One Thing, and just getting focused in and go take action. And so this will be good. So wherever you're at, there's going to be a little bit for everybody, and repetition is a law of learning. So even if you heard it before, come back and, get re-indoctrinated and plugged in. And so we look forward to seeing you there. As always, thanks Kevin, for being on.
Absolutely.
Ben, thanks for organizing this and getting all the marketing and stuff out. We always appreciate that, and co-hosting this along with myself. And thanks everyone for tuning in. Hope to see you December 3rd. Hope to see you in March, end of March, either in person. We'll have limited seating for that, and then we'll have a virtual option as well. And let's get after it. So y'all have a good night.
Thanks, guys.
Good night.